A mutual fund is an investment company where money of numerous investors are pooled together and managed professionally by a fund manager. The funds are invested in various securities with the aim of generating returns which can be higher than the interest rates of deposit products. However, mutual funds do not guarantee fixed returns and are not insured by the PDIC. When you invest in the ALFM mutual funds, you will benefit from having BPI Investment Management Incorporated as your professional fund manager who will manage investment risks, analyze financial market trends and movements, and select securities where your money will be invested. It spares you from the sariling sikap style of investing where you select and buy investment securities by yourself. Most importantly, it allows you to take advantage of BPI Investment Management's more than 40 years of fund management experience and expertise. Currently, the ALFM Mutual Funds is the largest mutual fund group in the Philippines with more than 100 billion pesos in assets. So how exactly does a mutual fund work? Investing in a mutual fund happens when a potential investor, like you, buys shares of a mutual fund that suits your investment objective and risk profile. The fund manager then invests the pooled money in various securities like time deposits, bonds, and stocks, which are carefully selected based on the mutual fund's investment objective. To determine the number of shares that you will receive, your total investment amount will be divided by the particular mutual fund's price per share or net asset value per share. The net asset value per share or NAV/PS is the price at which investors buy or sell each mutual fund share on any given business day. It is computed daily, considering all expenses such as taxes, management fee, and the mutual fund's operating costs. Take note that mutual funds are categorized according to investment objectives and its underlying investments. The four main types are money market funds that primarily invest in fixed income instruments with a maturity of less than 1 year, bond funds that primarily invest in medium to long-term government and corporate bonds, equity funds that primarily invest in listed stocks, and balance funds that invest in a combination of fixed income securities and stocks. Here's an example on how your investments can grow in a mutual fund. Let's say that you invested 5,000 pesos in a particular ALFM mutual fund whose net asset value per share is 100 pesos. This means that you will receive 50 shares of the fund. Now, let us assume that after some time, most of the mutual fund's underlying investment securities increased in value, thereby causing its NAV/PS to also appreciate from 100 to 110 pesos. If you still own 50 shares of the fund, meaning you did not make any redemption nor invested more, the value of your investment will increase to 5,500 pesos. That is a 500 peso difference or a 10% growth from your initial 5,000 peso investment. Take note, however, that as long as you have not redeemed nor sold your shares, this gain will only be considered as paper gain. This means that the value of your investment may still increase or decrease depending on the fund's performance. Similarly, a decrease in share price or NAV/PS from the time you invested in the fund will result in a paper loss. Just remember that paper gains or paper losses will only be realized when you sell your shares or redeem your investments from the fund. Ask our investment counselors about the ALFM mutual funds today.